What exactly is an ETF? ETF stands for Exchange Traded Fund. It's a type of investment fund that holds a collection of assets, such as stocks, bonds, or other securities. What makes ETFs unique is that they trade on stock exchanges, just like individual stocks. This means you can buy and sell ETFs throughout the trading day at market prices, making them a flexible investment option. Now, why are ETFs useful to investors? One of the primary advantages of ETFs is diversification. By purchasing a single ETF, investors can gain exposure to a broad range of assets, which helps spread risk. For instance, instead of buying shares of every company in the S&P 500, you can buy an ETF that tracks the S&P 500 index, giving you a small piece of all the companies in the index. ETFs also offer transparency. Most ETFs disclose their holdings daily, so investors know exactly what they're invested in. This is different from mutual funds, which typically disclose their holdings less frequently. ETFs are generally more cost-effective. They usually have lower expense ratios compared to mutual funds. This is because most ETFs are passively managed, meaning they track an index rather than having a team of managers actively picking stocks. Lower management fees can lead to higher net returns for investors. ETFs provide flexibility in trading. Unlike mutual funds, which are only priced at the end of the trading day, ETFs can be traded throughout the day. This allows investors to react quickly to market events and adjust their portfolios accordingly. So how is an ETF created? The process begins with a fund provider that creates the ETF and sets its investment objective. The provider then partners with a market maker or authorized participant, typically a large financial institution, to assemble the ETF's underlying assets. These assets are then placed in a trust, and the ETF shares are created. The shares are delivered to the authorized participant, who can sell them on the open market. This process allows investors to buy and sell ETF shares without directly impacting the underlying assets. Another important aspect of ETFs is that, unlike a company's stock, the number of shares outstanding of an ETF can change daily. This happens because of the continuous creation of new shares and the redemption of existing shares. This process is facilitated by authorized participants who can create new ETF shares by providing the underlying assets to the fund, or redeem shares by returning them to the fund in exchange for the underlying assets. This ability to issue and redeem shares on an ongoing basis helps keep the market price of ETFs closely aligned with the value of their underlying securities, ensuring fair pricing. Now let's look at a popular example of an ETF, SPY, also known as the SPDR S&P 500 ETF Trust. SPY is designed to track the performance of the S&P 500 index, which includes 500 of the largest publicly traded companies in the United States. When you buy shares of SPY, you're essentially buying a small ownership stake in all the companies within the S&P 500. SPY is one of the largest and most liquid ETFs in the world, making it a popular choice for investors looking to gain broad exposure to the U.S. stock market. Its underlying assets include shares of companies like Apple, Microsoft, Amazon, and many others across various sectors. In summary, ETFs are a versatile and cost-effective way for investors to diversify their portfolios, with advantages like lower fees, trading flexibility, and the ability to trade a basket of stocks in a single transaction. The continuous creation and redemption of ETF shares ensure that their market price stays closely aligned with the value of their underlying assets. Whether you're a seasoned investor or just starting, ETFs like SPY offer a convenient way to invest in a wide range of assets.